So what do you see here? And let's try to break this down step by step to see what we can learn about price action and how we can find the best trades. And in this video, I have a few very interesting examples where I show you top down how to find the best trades. So what do you see here? First, we have the fake out here in the most recent price candle. The market made a lot of swing lows here. And then this candle, the first time the market gave us a fake out. When we zoom out on the same time frame, we can see that this is happening when we look left at the previous demand area. This demand zone started this huge uptrend and the market is showing us once again a bullish reaction here. Now let's get to the lower time frame and we are on the 15-minute. This is the fake out that we observed, and what we see here is a trend change. A very large candle that is breaking the last swing high. The market is giving us here the first indication of a lower time frame trend change. But we don't want to get the bullish entry just yet, as we would be chasing the price. We wait a little bit longer and we see that the market is taking out a previous high point and is leaving this demand zone or order block here at this little area. So the trading plan would be to wait for a pullback into the zone and then look for buying opportunities. Shortly after, the market is pulling back into the zone and it is respecting the zone, which means that the market is shooting up higher. This is then used as an entry point. The stop loss for more aggressive traders would be right here underneath the last swing point. Some traders may also choose a lower stop loss price. We target the previous swing highs of this downtrending move and we would theoretically get a 3.47 reward to risk ratio, which is a good outcome. You can see the market reached the take profit and then kept going as the bullish trend unfolded. Let's try another example. What do you see here? We are on a 2-hour higher time frame and the market after this bullish move is now reaching another swing high point. Whenever the market is reaching those big important swing highs, we want to carefully observe the price action. Shortly after, we see that the market is showing us this really strong bearish reaction. This could be news driven. It doesn't matter whether it's natural price or news driven. The analysis is the same. We don't want to chase the price. We want to carefully observe what is happening. So let's try to see what the market is doing next. The market is pulling away first. Again, we're not going to chase the downward price after this huge injection of selling momentum. What we see is that on the move down, the price left this huge fair value gap. The dotted line is the midpoint of this fair value gap, and a lot of traders will use this as an entry point. What we see after is that when the market is reaching the midpoint of this fair value gap, we see a deceleration pattern. This is called a morning or evening star pattern, and it's a great reversal pattern. And afterwards, you can see this is where it happened. The market broke lower, came back, retested the previous highs, was not able to take out the previous highs, and then the market moved lower. The first target was the previous demand area that led to this move higher here, and then the market reached the previous lows, taking out those lows once again. So this is a great example of trading those turnarounds without chasing the market, waiting for a pullback into a better price area to get a much better entry price. If you like this way of trading and if you want to learn more about price action strategies, support and resistance, supply and demand, liquidity, and many other trading strategies, then check out my new trading program, which I call the Tradecademy. It's the ultimate trading program. I have a brand new trading course with over 80 videos. I constantly add new videos. You also get personally mentored by me, and you are joining a private community with a live chat room where you can always interact with me every single day. I also hold live webinars every week where you can look over my shoulder, ask questions, and interact with me. I have brand new trading strategies in the Tradecademy which have never been shared anywhere else before. Hundreds of trade studies, hundreds of chart studies, hours of backtesting. It's ideal for swing trading, day trading, and I basically show you how to trade all the different time frames. It works for Forex, commodities, cryptos, indices, and we even have stock traders in there. If you're interested, check the link in the video description where you find all the information about this special program, and we currently also have a special offer for you. So if you are fast and you want to join, then make sure to check the link, use the discount code, and then I will see you in my new program. Let's study some more price action. What do you see here? Clearly, what we see is that here's a huge resistance area that the market has used many times, and each time the market moved into the resistance, we have seen a sell-off. So we want to carefully observe the price action. And what we can see this time is that the market is showing us rounding of price action. We don't have a breakout, we don't have a break and retest, which would indicate a successful breakout. So in that case, at this point in time, I would say it's more likely to see a bearish reaction compared to a bullish one. It's not enough to jump on a trade just yet. We want to still carefully observe the price action. When we go to a lower time frame, we see this long-term range. We would call this a distribution pattern. In a trending market, especially in a mature trending market, as we have seen here, where we have seen a long trending phase, a long distribution often is leading into a market reversal. The longer a distribution and the longer a sideways phase goes on for, the less the likelihood of a continuation. And when you see then the breakout, very often this is leading towards a continuation away from the distribution. During the distribution, the buying and the selling powers are shifting. The buy traders, the people who bought long, on the way up have more and more unrealized profits. And then as the market keeps struggling here, you can be sure that more and more previously positioned long traders are thinking about taking exits and actually leaving their trades. And when long traders are exiting the markets, that is selling pressure. And also the market is probably high enough for a lot of new sellers to get into the trade. So you have this twofold impact on the price action, where you have the buyers leaving the market and new sellers coming into the market. And this is then leading to a new trend reversal. In this case, we don't have the pullbacks, so the pullback traders who have been waiting for a retest of the structure or a move back into this fair value gap, in this case, they wouldn't have gotten a chance. Only breakout traders would have been able to get in here. A new example, and this one is really fascinating. What do you see here? This is more of a complex structure and it's not such a textbook example. And in my opinion, the non-textbook examples really help us understand dynamic price action. So what do we see here? Let's try to dissect and analyze this chart. First, what we can see is if we pull the Fibonacci from the top to the bottom of this recent trending move, we see that the price has found resistance at the 50% level, right in the middle of the range. When a market shows weakness at this 50% level, that's often a sign that there's not a lot of pressure and not enough buying interest behind this move. And what we see after the market has reached the 50% level, we start seeing lower highs. And those lower highs are a clear indication of a fading bullish interest. But this is not enough and we don't want to get in short just yet. We need more information. You also don't want to short because the market is contracting. We draw the trend line at the bottom and we draw the trend line at the top, and we can see that the trend line is coming together, which means that the market volatility is decreasing and the momentum is dying down. The market is really slowing. What we would do in those cases is that we find the last swing point. The last swing point on the way up is this area here. And for a bearish trading scenario, we would need the market to break this area. So only if we get below this area, like in this case here, that's where you start shifting towards a bearish sentiment. And if we zoom in, you can see that the breakout left this fair value gap here. The next few candles pull back, close this fair value gap, and then we push lower. So this is another great example of a break and retest pattern. So breakout traders may have gotten in here a little bit earlier, and then the pullback traders in this case had another chance to get into the market. Usually pullback traders also have a much more favorable reward to risk ratio because they can short for a higher price. Of course, the drawback is that sometimes the market will not give you a pullback opportunity, as we've seen in the last example, and only breakout traders may get in. Another interesting study, what do you see here? The market has been in a downtrend, has been in an uptrend, and if we look at this chart, we find this balanced range here in the middle. This is an area of very huge interest in the market. It has been support here, led to a long sideways period. It was support here multiple times. On the breakout, the market is coming back into this zone. Here's also a fair value gap that the market has now closed. And when we go to a lower time frame, we see an interesting shift. The market suddenly is making lower highs, whereas previously in the uptrend, the market only made higher highs. This is an important shift in the market structure. When we look at this low, the market also made lower lows now, breaking the structure to the downside and continuing the bearish pressure. You want to get short when the market is breaking out of a range. You can see the market kind of went dead. This is because here's also the overnight trading range. The market is here just at the end of the day before a new day starts, and very often the market is just quieter when the New York session is closing and Tokyo is just about to open. The breakout happens a little bit later when the Tokyo and the Australian market open. This is the Australian US dollar. So when the Australian market opens, you can expect some more momentum to come in and the market to wake up. So this is a great example of also why you want to keep track of the time of trading. When are you actually seeing the momentum? And when do you want to get in? You don't want to get in when the market is inactive, but here at this point, this is then the signal that the market is waking up and the new traders that are just starting their day are driving down the price and starting this new downtrend. We have the first trend wave to the downside, slight pullback, continuation, slight pullback, almost reaching the previous lows, and then the next continuation to the downside. Let's take a look at another example. The market is here in this uptrend. The market made higher highs and higher lows throughout this uptrend. We see that we have a triple top at the upside. We also see that the market is having problems with this high. This was the highest high in this uptrend. The market then took quite a while to come back to this high, had this huge breakout candle, which probably lured in a lot of traders. But those huge breakout candles often lead to a lot of exhaustion, and this is often an exhaustion sign that the market is trying to make a final push, but this final push is then not being continued and the market didn't follow through. And afterwards you see suddenly strong selling candles coming into the market. We have this fair value gap that the market is creating on the way down. We are closing the fair value gap with this spike, and then the market is moving lower. So very nice study of the market tops and how we can understand trend reversals, weakness at highs and lows, capitulation and exhaustion around previous breakouts, and then the turnaround with the close of the fair value gap and then the following trend continuation.